Assalamualaikum. How to get pre-approved for a mortgage? Everything that a home buyer need to get pre-approved for a mortgage loan. As you search for a home, getting pre-approved for a mortgage can be an important step to take. Consulting with a lender and obtaining pre-approval letter provides you with the opportunity to discuss loan option, and budgeting letter provides you with the opportunity to discuss loan option and de-budgeting with the lender. These steps can serve to clarify your total house hunting budget and the monthly mortgage payment that you can afford. As a borrower, it's important to know that a mortgage pre-approval does and does not do, and how to boost your chances to get one. Key takeaway: going through the pre-approval process with several lenders allows to home buyer to shop mortgage rates and find the best deal. A seller often wants to see a mortgage pre-approval letter and in some cases proof of funds to show that a buyer is serious. The first step is filling out a mortgage application and supplying your social security number so that the lender can do a credit check on you. You will also need to provide extensive documentation of job history, assets, liabilities, income tax return, and more. Self-employed buyer and may need to provide additional documentation. After reviewing your application, a lender will offer pre-approval with the conditions or deny pre-approvals. Pre-approval like a physical exam of your finance. Before lender decide to pre-approve you for a mortgage, they will look at several key factors: debt to income, DTI ratio, loan of value LTV ratio, credit history, FICO score, income, employment history. Think of a mortgage pre-approval as a physical exam for your finance. Lender will like poke and probe into all corners of your financial life as a way to trying to ensure that you will repay for your mortgage. Pre-qualification versus pre-approval. You have likely heard the term pre-qualification used interchangeability with the pre-approval, but they are not the same. With the qualification, you provide overview of your finance, income, and debt to mortgage lender. The mortgage lender then give you an estimated loan amount. In the way, a mortgage pre-qualification can be useful as an estimate of how much you can afford to spend home. However, the lender does not pull your credit reports to verify your financial information. Accordingly, pre-qualification is a helpful starting point to determine what you can afford, but carries no weight when you make offers. On the other hand, a pre-approval involves filling out a mortgage application and providing your social security number so that a lender can do a hard credit check. A hard credit check is triggered when you apply for a mortgage. For this process, a lender pulls your credit reports and credit score to assess your credit worthiness before deciding to lend your money. These checks are recorded in your credit report and can impact your credit score. By contrast, a soft credit check occurs when you pull your credit yourself or when a credit card company to lender pre-approves you for an offer without you asking. Soft credit checks do not impact your credit score. Also, you will list all of your bank account information, assets, debits, income, and employment history, past addresses, and other critical details for a lender to verify. The reason for this is that above all, the lender want to ensure that you can repay your loan. Lender also use the provided information to calculate your DTI ratio and loan to value ratio, which are essential factor in determining interest rate and ideal loan types. All of this makes pre-approval much more valuable than pre-qualification. It means that the lender has checked your credit and verified the documentation to approve specific loan amount. Final loan approval occur when you have a payroll done and the loan is applied to a property. When to get A pre-approval. Mortgage pre-approval letters are typically valid for 60 to 90 days. Lender put an expiration date on these letters because your finance and credit profile, and expire date on these letters because your finance and credit profile could change. When a pre-approval expires, you will have to fill out a new mortgage application and submit update paperwork to get another one. If you are just starting to think about buying a home and suspect that you might have some difficulty getting a mortgage, going through the pre-approval process can help you to identify credit issues and potentially give you time to address them. Seeking pre-approval 6 months on to 1 year in advance of serious home search put you in a stronger position to improve your overall credit profile. You will also have more time to save money for a down payment and closing costs. When you are ready to make offers, a seller often wants to see a mortgage pre-approval and in some cases proof to fund to show that you are a serious buyer. In many hot housing markets, sellers have an advantage because of instant buyer demand and a limited number of homes to sell. They may be less likely to consider offer without pre-approval letters. The pre-approval process. Applying for a mortgage can be exciting, nerve-wracking, and confusing. Some online lenders can pre-approve you within hours, while other lenders can take several days. The timeline depends on the lender and the complexity of your finance. For starters, you will fill out a mortgage application. You will include your identify. For starters, you will fill out a mortgage application. You will include your identifying information as well as your social security number so that the lender can pull your credit card. Also, mortgage credit checks count as a hard inquiry on your credit reports. And may impact your credit score if you are shopping multiple lenders in a short time frame. Usually 45 days for newer shopping multiple lenders in a short time frame. Usually 45 days for new FICO scoring model. The combined checks count as a single inquiry. Here sample of a uniform mortgage application if you are applying with a spouse of other co-borrowers with whose income you need to qualify for the mortgage. Both applications will need to list financial and employment information. There are 8 main sections of a mortgage application: type mortgage and turn to loan.